Hello and welcome to Simplicity in Stocks. In these videos, we will dive into the important foundations of investing. This video will cover a step-by-step process on how to build a great dividend portfolio. There are two ways to make money in the stock market. There's the popular way, which is to invest for capital gains. Then there's the not so popular way, which is to invest for income via dividends. Investors tend to be focused on capital gains, but dividend investing is different. Dividend investors don't actively look out for growth stocks. They are interested in making regular income from dividends. So, what do they look for? Companies with stable profits. Why stable profits? Well, companies paying dividends year after year typically have a record of stable profits. The higher the stability, the higher is the share of profits that can be distributed. Paying dividends also provides an incentive for companies to increase their earnings so that they can pay an even higher dividend the next year. All else being equal, a company with a higher dividend payout is more stable than a similarly sized competitor with a lower dividend payout. This is why investing in stable dividend paying stocks can help investors sleep peacefully. These businesses generate steady passive income as long as you remain invested for the long term. With that said, let's get to the process of building the ultimate dividend portfolio. But before that, do keep in mind that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now, the first thing you should know about building a dividend portfolio is what you should not do. Don't blindly jump into stocks with the highest dividend payout. If a company is paying out all or most of its profits as dividends, it may not be a good sign. It could mean that the management can't invest the profits back into the business at a good return. Always look for companies with room to increase the dividend payout. Right, now let's discuss the 5 steps. Step 1. Shortlist dividend paying stocks. Companies with a long history of paying dividends are likely to continue paying dividends in the future. If a company either doesn't pay dividends or is inconsistent, it is best to avoid it for a dividend portfolio. Now, it may be a fundamentally good company. It may make it to a growth stock portfolio, but it is not suitable for a dividend portfolio. You should look for companies with a long history of paying dividends. This is the most important part of the process. Luckily, this is also the easiest step. You can shortlist dividend paying stocks in just a few minutes by using a stock screener. Step 2. Evaluate the financials. You will need to evaluate a company's fundamentals based on your comfort level and risk tolerance to decide if you want it in your dividend portfolio or not. Now, there's no strict right or wrong answer here. Every investor is different. Every investor has a certain risk tolerance. Some may be comfortable with growth companies that are using debt to fund the growth. These stocks may have a debt to equity ratio greater than 1. Other investors may not be comfortable with such a company. There are cases where the company may have a long track record of paying dividends, but its financials may not be great. It is best to not include such stocks in your dividend portfolio. Here are some criteria to apply to the companies that you have shortlisted: revenue growth, profit growth, debt to equity, return on equity, and a history of operating margin and the net margin. Step 3. Growth and moat. Apart from a company's fundamentals and its dividend paying track record, you will also need to pay careful attention to 2 points: profit growth and the competitive advantage, that is the company's moat. Growth is important because you are looking for a company that increases its dividend year after year. This is necessary to keep up with inflation. The smart money in the stock market is always on the lookout for companies that increase the dividend payout during difficult economic situations. Such companies are rewarded with high stock prices. Moat is a company's competitive advantage in its industry. This is important because without a moat, a company might struggle to grow after a few years. At that time, it might not raise the dividend payout or may even reduce it. A falling dividend payout ratio is a sure sign of a company that is struggling to handle the competition in its industry. This is why, when you are looking for dividend stocks, always pay attention to the competitive forces in the industry and the company's position in it. You can get started by looking for the following: dividend payout ratio below 40%, net profit growth above 20%, return on equity ROE above 20%, and also higher than the net profit growth. You can change these numbers a little bit based on your screening process, but ensure that the payout ratio remains below 50% and the ROE is always more than the net profit growth. Step 4. Dividend yield. The dividend yield is the dividend per share divided by the current market price of the stock. It tells us how attractive the company's dividend is compared to its stock price. A high dividend yield is desirable, but be careful. Often a high dividend yield can mean the market is not happy with the company. This could be because the company doesn't have good growth prospects. Such companies pay out most of its profits as dividend because there aren't many opportunities to reinvest the profits back into the business. This artificially boosts the per share dividend paid out, which in turn results in a high dividend yield. Remember, it's usually better to own a stock in which the dividend payout can increase over time. This is not possible in the case of a company with poor growth prospects. Also, a high dividend yield could mean that the stock is cheap due to reasons the market doesn't like. The dividend payout may not have much to do with the yield. It's just that the market may not like the stock. These stocks will have low PE and or low PB ratios along with a high dividend yield. In such cases, take the time to understand why these stocks are cheap in the first place. Find out the stock's underlying problems. After you have understood the reason for the market's dislike for the stock, you will then have to decide if you agree or disagree with the market. If you think the market is wrong, then that high dividend yield stock might find a place in your portfolio. But if you agree with the market, then it's best to avoid that stock. Of course, there is always a chance that you might be wrong in your assessment. This is a risk that every dividend investor takes with high dividend yield stocks. 5. Continuous monitoring. This is a very important final step that many dividend investors ignore. Just because a company is a good choice for a dividend portfolio doesn't mean that it will stay that way. The business world is highly competitive. A company with great fundamentals paying great dividends may fall on bad times due to any reason. Keep a close watch on the fundamentals of the stocks in your dividend portfolio. Track the developments in the companies and their industries closely and regularly. You may find some stocks don't deserve a place in your dividend portfolio. Replace these stocks with others. Well, there you go. With this 5-step process, you are well equipped to build your own dividend portfolio. Share your thoughts in the comments. All the best and happy investing.